At the Bank of Canada, we think of financial stability in terms of vulnerabilities, that's potential weaknesses in the financial system, and risks, which is when those weaknesses become real. There are two vulnerabilities related to housing that we are focused on right now. Households that are carrying a lot of debt, and imbalances in the housing market, such as house prices rising at an unsustainable rate. People can often cope with these vulnerabilities for an extended period, but an economic shock, such as a severe recession, could trigger a negative chain of events. We could see a sharp increase in unemployment. Many households would be in a difficult position, especially those with a high debt load. They could have trouble meeting their debt payments. Some households would likely default on loans. This would affect lenders such as banks and trust companies. When a default occurs, the lender tries to recover the value of the loan by foreclosing and selling the house. At the same time, other households are likely to delay house purchases until the economy improves. In a housing market that is already vulnerable, this pressure could cause a large drop in house prices. A decline in house prices would push down household wealth, possibly reducing spending. Broader economy would also feel the impact through stress on both large and small lenders who would need to reduce their new loans. The good news is that stress tests show that the big Canadian banks are able to handle even a large drop in house prices. Still, the impact on the broader economy and on the financial system would be significant. That's why the Bank of Canada regularly monitors and reports on these risks and vulnerabilities in the financial system review.